Good morning. Accounting for joint venture. Accounting for joint venture. First of all, we understand the meaning of joint venture. Joint venture means joint business. Here, two or more persons likely to join together to doing a business is called joint venture. Further, two or more persons undertake a particular business with contribute capital to earn profit and share the profits in an agreed ratio. In the absence of any agreement, profit will be divided equally. It is usually a temporary business or a temporary partnership without the use of firm name. Here, X and Y are two persons. They are doing business separately, but now they are jointly to undertake a particular or specific business for temporary is called joint venture. The participants in the joint venture is called co-venturers. This business is resemble of partnership business, but it has varied from some respects. The major difference is joint venture is a short-term or temporary business, but partnership is a long-term or continuing business. The next areas of business where joint venture form of business can be adopted. Here, some examples of joint venture business are suitable business for to undertake joint venture. Joint consignments, special shares, underwriting of cash or debentures, contribution of a building, distribution of goods, sale or purchases of properties. These are examples of joint venture business. Characteristics of joint venture. Two or more persons agreed to undertake a particular business. When the completion of a particular business or a venture, the temporary partnership comes to end. It means wind up the business or terminated the business. There is no media name to the firm. The major objectives of a joint venture is to earn profit, and the profit also shared by all the co-venturers in an agreed ratio or predetermined ratio. In case of there is no agreement, they will share the profit and loss equally. Okay. The next, benefits of joint venture. Benefits, advantages, merits, essential, significance, and why the joint venture business undertaken or essential of joint venture business in business. Also the same meaning. Sharing risks. Every business have some risks like that in finance, in technical, in manpower, in social, in economically, in political, and so on. So these business risks are shared by more number of persons. So it has not affecting the individual person or a firm. So the business have go through smoothly. The business has go through smoothly. Financial resources. Some venture or a task require huge amount of funds or finance. At the time, more persons contribute to the finance. It leads to easily to take or able to undertake a big projects and earn more profit. Okay. Sufficient experience. Every people have possessed some unique skill, ability, efficiency, and experience to do something effectively. Something effectively, such as managerial skill, technical skill, and able to contribute huge finance, and so on. These are can come together to undertake costly and profitable project and execute them effectively and efficiently. So we understand sharing risk, financial resources, and sufficient experience are the major benefits of joint venture business. Let us go to the next. Difference between joint venture and consignment. Relation between parties. In joint venture, parties are like owners, like a owner. In consignment, parties are called principal and the agent. Methods of keeping account. In joint venture, there are 4 methods are available for keeping accounts. In consignment, only one method is available for keeping records. Profit earned. All co-venturers share the profit in an agreed ratio or equally. In consignment, only the consignor enjoying the profit and suffered when arising loss. Account sales. In joint venture, account sales is not sent by co-venturers to another, but in consignment, account sales is sent by the consignee to the consignor. Management. All the co-venturers having the power to manage the business, but in consignment, the consignor only having the power to manage the business. Finance. All the participants can contribute fund into the business in a shortage proposal, but in consignment, the consignor only invested funds into the business. Parties. The parties are called co-venturers. Here in consignment, the parties are called consignor and consignee. The next, difference between joint venture and partnership. Name of the firm. There is no media name. There is no media firm name in joint venture, but in partnership, firm name is essential. Co-venturers are partners. All the participants are called co-venturers in joint venture business, but in partnership business, parties are called partners. Continuing or continuity. After the completion of a particular job, the temporary partnership comes to end in joint venture business. But in partnership, continuing for long term of the business. Liability. In joint venture, limited liability, but in partnership, unlimited liability. Location of your business. Joint venture located in one specific place, but in partnership may be located of different places. Positions of a minor. Usually minor is not admitted in joint venture, but in partnership minor can also be admitted, but only participate the benefits of the business, not in class. Application of the act. There is no specified act for legal purposes in joint venture, but in partnership, Indian Partnership Act 1932 is applicable for legal purposes. Number of partners or members. There is no limit in joint venture business, but in partnership is restricted to 20 in ordinary business and 10 in banking sector. Methods of recording joint venture transactions. Here, 4 methods are followed by joint venture business. The first one, when one co-venturer is appointed to manage the joint venture. Here, accounting transactions are recorded and maintained only one co-venturer at the same time. Others are only contributing their share of investment. The second one, when separate set of books are not maintained for recording joint venture transaction. Here, each co-venturer opens a joint venture account and the personal account of other co-venturers account. The third method, when separate set of books are kept for joint venture. In this method, the accounting treatment is similar to that of partnership transaction. The fourth method, when joint venture transactions are recorded through the memorandum joint venture account. In this method, every co-venturer will open a personal account and a memorandum joint venture account. These are discussed in These are discussed briefly in next session. Thank you.